Well, we've actually been talking about pricing from the very beginning of the course, but the economist view of this is actually a pretty simple one. We have a model. Model suggests firms are going to maximize profits. Then we argue that firms should set marginal revenue equal to marginal cost, find their profit maximizing quantity, and in the case of perfect competitors, they simply take the market price. In the case of the other firms, the firms should go to the demand curve and find the price in the market. Well, many people argue that that's, quote, not real world, that firms can't actually do that, and I'm not sure that I agree with that. In fact, many cases I don't think firms give enough thought to what they think their price ought to be. But we ought to at least talk about some sort of alternative ways of going about pricing besides the simple MR equal MC find price sort of model. And one of the really interesting ones to talk about is price discrimination. And given that I went to a movie yesterday and took my 10-year-old son, the timing seems to be right. But what do we mean by that? And what we're really saying is that if you charge different customers different prices and yet the costs of production are the same, then it appears you're discriminating in terms of price. Now, what we're arguing then is that firms really have to have the ability to change price. So obviously a perfectly competitive firm can't do this because there is simply a market price, and that's the only price they'll charge at. So we argue that firms have to have at least a bit of a degree of market power, and by that we simply mean they have to have a downward sloping demand curve. Obviously a monopolistic competitor, monopoly, oligopoly, all of them would qualify to at least potentially discriminate in terms of price. But what we also have to have is customers that are different, and that firms have an ability to break them up into groups or sort of at the extreme individually price based on a maximum price that people are willing to pay. So firms generally have to be able to segment the consumers into different groups and find a way to charge them a different price. And one of the real keys, of course, is that we can't allow the consumers to resell the product. In other words, if you buy low, we can't let the consumer sell it to somebody else because the firm would lose their ability to discriminate in terms of price. They might be able to buy cheaper from other customers. So you have to be able to prevent resale of the product. Now, there are different sorts of price discrimination. And in the most extreme case, we might argue is what's called first degree price discrimination. And by that, what you're saying is that the firm is capable of charging every single customer a different price, and that price is the maximum price they're willing to pay. So really the firm is sort of tracking down the demand curve, that the firm can find the individual points on the demand curve, find the consumers at each of these individual points, and charge them that highest price, that price right on the demand curve. Well, that seems improbable. In other words, it seems like it would take a lot of information. But when you think about it, the funny part is that it's not too clear the universities, certainly public universities perhaps not, but private universities seem to have an ability to do that, or at least come close to it. In other words, Quinnipiac may be able to do this. But what we'd argue is that this would occur at the undergraduate level, not at the graduate. In other words, we really think all of you are paying the same tuition, but undergraduates, are they? Well, think about how a university could determine different willingness to pay by students at the university. So in other words, what factors would go into willingness to pay for tuition? Well, some may seem obvious to you and others not so obvious, but one would be family income. In other words, all else remaining the same, universities, when they find out what your family income are, would think that students from higher income families would be willing to pay more. So that would be one way to sort of separate out consumers. But what other information do universities gather that might help them? And another answer would be SAT scores. In other words, the higher your SAT score, the more substitute universities you would be able to attend. So that actually would mean it'd be more difficult for universities to charge you a higher price. And the same would be true of your high school grade point average. If you have a higher grades in high school, all else remaining the same, you have more schools that you are able to substitute for the one that you might be looking at that point in time. And so the university would realize they couldn't charge you as high a price. So consider, then the university sit there with your information on income, SAT, and grade point average, and then they'll sort through that information, and they have a pretty good idea how much they're able to charge you in terms of tuition. And okay, maybe not every single student pays a different price, and maybe not every single student pays the maximum they're willing to pay, but they actually get fairly close to perfect price discrimination in this case. So in rare instances in the real world, it's possible. The other interesting thing about this is if you are able to perfectly price discriminate, what you're also able to do is transform that demand curve, downward sloping demand curve, remember in this case, into a marginal revenue curve. The marginal revenue and demand curve are the same for perfectly competitive firms with horizontal demand curves, but in the case of a downward sloping demand curve, the only time the marginal revenue and the demand curve are the same and are the demand curve is when they perfectly price discriminate. So the really sort of wacky thing that happens in this case is the profit maximizing firm would track down the demand curve, which is its marginal revenue curve, all the way until it hits the marginal cost curve, and then determine their quantity there. And the really funny thing about that is that's the same outcome as under perfect competition. So obviously this would make consumers as happy as perfect competition, and the answer is obviously not, because instead of charging a price equal to marginal cost, all but the last consumer would be paying a price well above marginal cost, that point on the demand curve. So this process actually eats up all of the consumer surplus of consumers, and the firms are really the ones that gain from this. But a more realistic case of price discrimination in the real world is what we call third-degree price discrimination, where you break up consumers into a couple of subgroups based on elasticity. And the objective at that point, and it goes back to the understanding of elasticity, if you can break them up into subgroups based on elasticity, the less elastic group would be charged a higher price, the more elastic group would be charged a lower price, and the firm actually in this case would increase revenue sort of in both directions. Higher price inelastic revenue goes up, lower price elastic revenue goes up, and the firm's profits would clearly go up. In other words, they'd want to sell the same number of units, but sell to one group at a higher price, other group at a lower price, raise revenue from both groups. Since the quantity stays the same, their cost stays the same, their revenue rises, their profits rise. So we see this sort of behavior all the time. Airlines, baseball teams, football teams, movie theaters, where I took my son the other day. And what I showed you, if you read through the written part of the notes, though, interesting thing about this is if you apply a little bit of math, third-degree price discrimination is actually quite possible to achieve in the real world. In other words, if you have a pretty good idea what the elasticity of demand is, when you read through those notes, you'll see that by applying the basic rule MR equal to MC, so rearranging your terms, if you know your elasticity, you know what price would maximize your profits. And the interesting thing about this, again, when you go through the notes, you look at the difference in the elasticities in the two groups. One was 1.01. The other was 1.25, and you see an enormous difference in the price that the two groups would pay. And you see exactly that at baseball games, don't you? In fact, it's actually potentially more than that. Now, let me add one other thing about this. In the real world, we have to look at price discrimination slightly differently than the pure theoretical model that says costs are the same, and therefore when the prices are different, there's price discrimination. Do we still have price discrimination in the real world if the marginal costs are different and the price is different? Well, let me give you an example. Suppose you have two groups. One group has a marginal cost twice the other. Then if the group with a marginal cost twice as high paid twice the price, you'd probably argue that price discrimination didn't exist. But what if the one group had twice the marginal cost but paid 4 times the price? It appears we still have price discrimination. Maybe not in its purest form, same cost, different prices, but the price isn't perfectly linked to the cost in this case. Double your cost, 4 times your price. It appears there is price discrimination going on. And that may well be what we see at a baseball game. I'm not going to argue the marginal cost of the best seats in the house is identical to the cheapest seats in the house, but I'll bet you that the price difference between the best seats in the house and the worst seats in the house is a bigger difference than the marginal cost difference. In other words, it might cost $2 in terms of marginal cost for the cheapest seats in the house, $20 or even $10, let's say, for the most expensive seats in the house, but the one might sell for $10 and the other sell for $1,000. So the sort of perfect model of price discrimination may not apply in all cases, but also consider when the cost differences don't match the price differences in terms of proportions, we probably still think of that as price discrimination.